Welcome to Manager EDU. Today, I will teach you return on assets. I will define the ratio, explain its formula, give an example, and clear your concept about what the value of the return on assets ratio means. So, let's get started. Return on assets, or ROA, measures how efficiently a company uses its total assets to generate profit. In simple terms, we compare a company's total assets with its net profit to see whether the company has used its assets efficiently or not. If the return on assets value is higher, it is a good sign for the company because it means the company is generating more profit from each dollar of assets. If it is lower, it is not a good sign, as it indicates the company is not using its assets effectively to produce profits. Let's learn its formula. Return on assets equals net profit divided by average total assets. Here, average total assets means the average value of assets during the year. It is calculated as average total assets equals beginning total assets plus ending total assets divided by 2. Let's take an example. Suppose we have a company named ABC. For the year 2026, beginning total assets $1 million, ending total assets $1.2 million, net profit for the year $200,000. First, we need to calculate average total assets. So, beginning total assets $1 million plus ending total assets $1.2 million equals $2.2 million. Now divide that by 2. So, $2.2 million divided by 2 equals $1.1 million. Net profit, $200,000, divided by average total assets, $1.1 million, equals 0.1818. When we multiply by 100 to express it as a percentage, we get 18.18%. So, the return on assets in this example is 18.18%. Now let's understand what this value means conceptually. We can see that the company ABC have the total assets like total current assets, total fixed assets, and total intangible assets to compare with net profit. An ROA of 18.18% means that for every $1 of assets the company owned during the year, it generated approximately 18 cents of net profit. In other words, if we consider the company's total assets as 100%, then the net profit earned from using those assets is 18.18%. Simply put, return on assets measures the company's ability to generate earnings from its assets. It tells us whether the company has utilized its assets perfectly or not. This ratio is very easy to understand, yet it is a powerful and widely used formula in financial analysis. Thanks for watching.